Welcome to the CIO Chair, a podcast hosted by the CIO Investment Club in collaboration with the Pension Insurance Corporation. In each episode, we will sit down with top chief investment officers to explore their unique investment philosophies, decision-making processes, leadership strategies, and personal career journeys. Now let's get started. Welcome everyone to the CIO Chair, hosted by me, Sean Thompson.
And me, Hartaj Singh.
The CIO Chair's guest today is Rob Groves, Chief Investment Officer of Pension Insurance Corporation, a London-based specialist insurer of defined benefit pension funds. Prior to joining PIC in 2015, Rob was CIO at Friends Life, overseeing assets totaling over £100 billion. And before that, worked for UBS, Commerce Bank, and Towers. At PIC, he has responsibility for the management of their portfolio, including asset and liability management, manager selection, and interest rate and inflation hedging strategies. PIC has around £55 billion of assets under management, invested in a mix of public credit and privately sourced debt. Their assets are managed in-house and with third-party asset managers. Welcome to the CIO Chair, Rob. It is an absolute pleasure to have you here. And as I always say to our guests, I hope you are sitting comfortably.
Thanks, Sean. Thanks, Hartaj. Look, delighted to be here. Definitely sitting comfortably. And I've got my kneeling chair, which is my new addition to give my better posture. So hopefully I'll be sitting particularly comfortable. But absolutely really looking forward to the conversation.
Fantastic.
I'm also looking forward to it. Normally, Rob is asking me questions as my boss, but I'm looking forward to turning the mic this way.
And I'm hoping you give me some easy questions or career opportunities, maybe more limited.
I'm here to ask the hard ones, Rob.
Fantastic. Rob, let's start. When we're asked, what does the journey to a CIO look like? Could you give us a sense of your journey into the investments field and to your role as a CIO?
Sure. Yeah, so I'm old enough that I started my career back in the kind of late 90s, and I was interested in like maths and economics and probably a bit of investing, but I didn't really know anything about the investment industry, and became an actuary, probably not because I had a sort of desperate desire to do, but just because I didn't fancy working in an investment bank where you work, it felt like you're going to sell your soul to the devil, but thought I was interested in maths and economics and thought there was a good qualification. So I did that for a few years, but quickly worked out I wanted to get onto the investment side. And then the obvious route for me there was through investment consulting. So I did that for a while. But then I think I spent like the first probably 5 years of my career really trying to work out how I was going to get closer to the action and make some early career choices and take you down a kind of particular path. I did investment consulting for a few years, really enjoyed that, and then went into investment banking. And this was pre the financial crisis when investment banking was seen as quite cool and sexy, which it's less now. And that was a lot of fun. And I learned a huge amount. But still, to that point, I probably at this point spent over 10 years of my career, but had never actually been an investor properly. And that's really what I wanted to do. And then the opportunity came to move to Friends Life. I'd never worked for a life insurance company. And I remember a recruiter calling me up saying, this is probably not for you, but you fancy doing this. And I just thought it sounded like lots of fun. And it was at a time when the industry was changing quite rapidly and Friends Life had been bought by kind of Resolution, which is like Cowdrey and sort of a kind of private equity style backing. And that was probably a pivotal moment in my career and moved into doing something I love, which was investing directly, investing for liabilities with an insurer.
And you're quite young in terms of when you became a CIO. Were there any risks you took or lucky opportunities that you got along the way?
Yeah, I think if you looking back now with the years, I'd done quite a few different things. So I'd worked in the public sector, the government actuaries department. I'd done consulting to pension schemes. I'd worked in an investment bank. And probably from a personal perspective, I probably didn't, that was me trying out different things. I didn't really know what I wanted to do. But then I think by the time when I did work it out, actually those experiences were really useful because I'd worked in a variety of different cultures and all of those has had investment decision making at some level. Some of them were quite salesy, some were not salesy at all, but all of them were about understanding kind of institutional investment. And I think probably the biggest thing that helped me, I remember when I was at Friends Life and I joined as head of asset liability management, was that we had lots of people who were specialists on the investment side. And then we had lots of technical ALM actuaries who understood the balance sheet really well. But there wasn't really anyone who could do both of those. So knew enough of the balance sheet and understood that technical side, but also could speak investment speak. So I saw that as an opportunity. And it was something that came to some degree a bit naturally to me, but I needed to like bulk up both of those skills. But once I did, what I found is you became a really useful voice in the room because you understood everything about the balance sheet and what the actuaries were talking about. You spoke the same language as the investment team. So suddenly you were really quite an influential person in the room. So that's probably I don't know if I call that a lucky break or sort of an opportunity that I saw, but that's definitely where my career flourished.
Yeah, that's where the skill sets joined up for the role. So today you are a CIO. What does your day-to-day look like? And what do you think is the essence of a CIO role?
I guess for a second, I think it's worth giving a little bit of context to Pension Insurance Corporation and what we do, because I think that helps answer that question. So we're a regulated insurance company. We do one thing, which is bulk annuities. So that's taking on old defined benefit pension schemes in the UK. And also each transaction we do, so we do multiple transactions a year, is like an M&A transaction. So effectively, either for part of or whole of the or for all of the scheme, the trustees are transferring their assets and then the responsibility to us to pay the liabilities to their members and for the rest of their lives. So what that then means is that we're working in an environment where we're buying long dated assets to match those kind of liabilities. And sort of regulation is a kind of a huge part of what we do. So if we're taking on responsibility for paying hundreds and hundreds of thousands of pensioners' incomes, we're required to hold capital. There's lots of rules around how we invest. So that sort of context is quite important.
Can I just ask, Rob, before you go on to the answer of the role of the CIO as you see it, just for our listeners, what's the reason for why pension schemes might go down that route and appoint someone like yours to insure them, right? To
Yeah,
ensure they,
absolutely.
what's the reason for doing that?
Yeah, so if you went back sort of 20, 30 years, sort of defined benefit pension schemes in the private sector were really common. Most companies would have offered a DB pension scheme, or certainly most large kind of corporates would, and they're now much less common. So typically what's happened over the years is for various reasons is those schemes have become closed to new members, so a new employee doesn't become a member of the DB scheme, and typically they've become closed to future accrual. So even for people who have joined many years ago and were a member of the DB scheme, they're now not earning a DB pension anymore, and they've been transferred into a defined contribution scheme. So what that means then for most companies, not all, but for most, is that these are like legacy issues. And over the years, they've caused some huge balance sheet volatility for these corporates. And particularly when interest rates were particularly low, a lot of companies were having to spend huge amounts of money putting money into their pension scheme to ensure that they remain solvent. So for lots of companies, has been on a quite financial journey with these DB schemes and have seen large sort of impacts on the company, but they are effectively legacy issues, legacy kind of schemes now that the management and the employees are no longer sort of members or sort of active members of those schemes. So if you're looking then to reduce the future financial impact on your company from the pension scheme, the clearest way to do that is to transfer the assets and liabilities to an insurance company. And it's like you'll see this often for a lot of companies. The pension scheme can be a bit of a millstone around the kind of neck of the company, and they can kind of stop them perhaps doing M&A transactions. Or sometimes you'll see companies where the pension scheme is significantly bigger, and you still see this with some listed companies in the UK, than the company. So rather than the management of the company focusing on what they're really good at, which is running the company, they have to spend unnecessary amounts of time
Got it.
focusing on the pension
Thank you.
scheme.
I'll let you now answer the question, which was, what is the role of the CIO as you see it?
If I look at what's the role of the investment team first, and then what's the role of the CIO building from that. So, overall, the investment team at PIC has overall responsibilities for the performance of the assets and the hedging strategy backing PIC. And I always kind of say PIC's an insurance company, but ultimately, really, there's two ways we can make or lose money. One is people living longer or less longer than we expect, so longevity. And the other is investment performance. And largely we hedge longevity. So although PIC's an insurance company, we're a regulated insurance company, we're capitalized as an insurance company, the investments are the beating heart of what we do. My job as a CIO is making sure we've got a really effective investment team that's all over our investment strategy. So looking at what we invest in, understanding the risks, trying to find attractive new investments, making sure that we're hedged against the risks that we don't want to hedge. Overall, I guess I see the role of the CIO is making sure that you've recruited a really strong team, you're organized in the right way, so you're operating effectively, and you've built a culture such that you can do that. And to me, culture is everything. If you've got good people, you've got a good culture, then the investment performance will follow.
Could we just dig deeper on the what is a good culture? What do you think are the key attributes of a good culture?
this is not a kind of collection of big egos. You really want, to me, it's like a culture where people feel able to express themselves, able to, I think, objectively express opinions on areas that are not their own. You'll know this, Artish. We've spent a lot of time over the last sort of year and a half as a kind of senior leadership team working out how we can get better, how we can do better, if there are any silos there, how we break those down. And a key part of that to me is making sure that you're really transparent with everyone across the team. If there are things that people don't understand that are not in their area, they need to be able to ask those questions. They need to be able to challenge those things. They'd be, for me, key aspects of what kind of creates good culture. And I think that you really want that, just that point around the no egos. But look, we've all got egos, haven't we, to some degree? But it's like, can you put it aside and try and work for the best of the company, the best of the team, and to try and get the best investment strategy you can in a really objective way? And I'm quite a big believer in, there's sort of a management style which is called 5 Dysfunctions for Team, and working through some of those things. And you'll recognize, I think, when you read that book, the challenges in the way teams interact with each other, but also ways to improve.
So, Rob, taking us back to the options for pension funds, what do you see as the key options for pension funds, and why might they choose one option rather than another?
Thanks, Artish. I think there's 2 main strategies. You could also run a combination of the two, but there's different ways you could implement those as well. So the 2 main strategies are either to do a bulk annuity or to run on. Or actually, as I would probably say, I would say run off. Run on is a slight misselling. I'll explain what those 2 mean. So one is, if you do the run on / run off option, that's you maintain the pension scheme within a trust environment. So you have trustees that are responsible for running the kind of scheme. They'll retain the responsibility for paying the pensions as they fall due, and they'll retain control over the investment strategy. And the potential benefits of that strategy are that you could look to potentially work the assets maybe a little bit harder. And if that is successful, then ultimately that could lead to you generating a surplus within the pension scheme. And then there's a decision to make around what you do with that surplus. Is that going to go back to the sponsor? And there's some challenges associated with that. Are you going to use it to augment kind of member benefits? So that would be the upside of that strategy. Clearly, the downside of that strategy is that strategy may not work. If the investment strategy in particular is unsuccessful, if there's regulatory change in the future, that could mean that running the pension scheme becomes significantly more expensive. And you don't have to go back very far when we were seeing most pension schemes were in deficit and paying huge contributions. And you could say we've been in this, that's not the environment most pension schemes are in now, particularly because we've had strong investment markets and high interest rates. If you go back to the 90s when pension schemes were in surplus then, and they were all taking contribution holidays, and you can see how that worked out. So there's definitely a risk, I think, that pension schemes could be too focused on the strong financial position that they're in now, and they could double up on that bet. But for some schemes, that will be the right answer, particularly if you've got a really strong covenant, you're all over your kind of investment risks, and you've got a well-controlled investment strategy, that could be appropriate. I think, though, for most schemes, they will be on a journey to bulk annuities, and really the kind of question is, are you going to run on, run off for a period of time, or are you going to do a bulk annuity now? And ultimately, that's the only way to really extinguish your kind of liabilities, is to transfer the assets and liabilities to an insurance company. The advantage you get from that is once you've done that, you really lose the sort of financial exposure from the pension scheme. And then I think if you look at the advantages of bulk annuities, if you compare it to the pensions kind of environment, sort of key benefits, you've got the benefit of scale from an insurance company. The way that they invest assets is typically in a very safe way. So we're looking to hold long dated investment grade debt, and we'll match those cash flows, the pension cash flows, out into the future. I think if you contrast a pension scheme and an insurance company and you think about surpluses or deficits, a pension scheme can run a deficit. An insurance company can never run a deficit. We're required by regulation to always pay significant surplus. So our shareholders put in significant amounts of capital. So you've got this very safe, really well-controlled investment strategy that you benefit from scale, but you've then also got the additional money that our shareholders put in to provide policyholder protection. We're in a sort of fortunate position overall that the UK pension scheme finances are just in a much better shape than they would have been if you went back 5 or 10 years ago. I guess the question is, do you now double up on that and take more risk, or do you actually look to de-risk your pension scheme further?
Do you find that running a pension scheme under an insurance company constrains you more in terms of obviously the fact that you've got the regulation and you've got Solvency II? How does that work, being it's come from a pension background to an insurance industry?
Yeah, look, it's a great question. I think the 2 answers to that overall. Yes, the regulations are definitely more constraining from if you compare the investment strategy of an insurance company versus a pension scheme. And quite rightly, I think, because we are there to be the safe option. You really can absolutely sleep at night, and almost like regardless of investment performance, we're going to be there to pay your pension. I think then, almost like on a personal level, though, the things that I think are really interesting about doing this job is we've got a really large, really highly skilled investment team whose job it is to find really interesting investment opportunities. So we've got about 125 people in the investment team at PIC. And it's not to say there are no large investment teams at UK pension schemes, but it's much less common. It's really only the really big, like things like the LGPS pools or USS or some of the really large, like corporate, like bank pension schemes where they'll have a large investment function. So I think what we end up doing is more niche and is much more sort of fixed income focused than a kind of pension scheme. But we get really deep within the fixed income world. So that to me is a fascinating challenge. And then almost the insurance balance sheet side is perhaps like the geek in me finds that quite interesting, and working out how we're going to do the best for our policyholders, invest in the right things, but also get a good return for shareholders is a really interesting challenge.
And so just to follow on from that, Rob, like, why do you think there's so much interest internationally from this market, whether it's private equity providers or private credit providers? Why is this such an interesting market for them?
Yeah, I think it's a really interesting question, right? And actually, I think there's sort of a further part to that is because if you look at the share prices and the dividend yields of the players, so the listed players within their market, what that's really telling you is that the listed markets don't really like annuity business. And the things that they get worried about is it's like capital intensive. Each time we write a bulk annuity deal, as I spoke about before, our shareholders have to put aside a significant amount of capital for that. And they get worried about things like all the illiquid assets and perhaps providing kind of things like internal ratings. So the public markets just don't particularly reward it. If you look at the really large players, their dividend yields, they'll be very high single digits, which typically would be telling you the market doesn't believe that dividends is sustainable. Actually, I don't think that's really what they're saying. I think they're saying they find this market hard to understand and they're not keen on the capital intensity. But conversely, actually, the private capital providers really like this market. And that to me is around, if you look at, we've got these sort of very sticky, long dated liabilities, and actually we need liquidity, so for the kind of the flexibility of our investment strategy, but it's not as if a pension scheme is going to come along and withdraw their assets from us overnight. So actually, if you look at what's happened in the terms of the growth of the private credit market, particularly, and a lot of that has been through alternative asset managers, although becoming less alternative now and becoming more mainstream, they can see where their skill sets as a sort of a providers of really high quality investment grade credit meet the needs of the bulk annuity industry, which is to find those excellent assets, but perhaps where actually liquidity is less of a focus. So I think there's a few things going on. They're generally great at sort of really strong at providing private credit assets, and actually they just fundamentally view the market in a different way to the investors in the listed market. So they see there's an opportunity there that perhaps the listed market's missing.
So, Rob, maybe you could just tell us a little bit about how you go about allocating investment strategies, and also more in particular around about how you think about these things in uncertain market environments and what you might look to do for the portfolio when you're managing it.
Sure. I kind of start off by saying I'm really not a believer in sort of strategic asset allocation at all. That process where you sit down at the start of the year, look across, and then you start making decisions of, I'm going to put 20% in public credit, I'm going to put 30% in private credit, this much in government bonds. I think that's a really inefficient way to take in investment decisions. So I really value optionality. Building on that, over the year, we're not going to do hundreds of bulk annuity transactions, but we'll do tens of transactions. And we might easily take on sort of 8 billion plus of assets and liabilities in a particular year. So what I think is really important is having sort of maximum flexibility. So each time we're taking on a new pension scheme or kind of part of a pension scheme, we'll want to do a mini strategic asset allocation at that point, where we'll look at what are all the potential assets we can invest in. What's our kind of pipeline? How do we feel about the kind of risks of those kind of potential assets? What's the kind of price that we need to get to win the deal? How are we feeling about the returns to our shareholders? And all of that goes through an optimization process, which is quite quant based. And then we'll have qualitative reviews to see how do we feel about that portfolio. And through that, we then iterate to a final portfolio. Then we have lots of very tight risk limits which stop us doing any silly things. Are you stopping yourself over allocating to a particular sector, to a particular issuer? And then one of the things we've built out in the last few years, we've really built out our sort of portfolio optimization process on the in-force book. So Hartej will know this well. He and his team and some of the quants and some of the credit research team will be looking to find opportunities to improve the portfolio on a daily basis. And again, the quantitative modeling parts of that are really important. Every day we're looking to effectively, are there bonds or are there credits in the portfolio that either we don't like or where the kind of return we don't think is paying us enough for the risk? Are there better things that we can invest in? And we're looking to marginally improve the kind of portfolio every day.
It's interesting because when you look at pensions, you automatically think long-term investing. But here you are telling us that actually you are on a daily basis looking to adjust the portfolio and find attractive areas to invest in. Is that normal? Is that unique to yourselves? How does that normally work?
Yeah, conversely, I would still think of it as long-term investing, and say why in a second. I think it's definitely an area where we're leading the market. The way I think about it is you buy a bond or a loan at the start, perhaps when you've taken on a new bulk annuity deal, and in theory, you're quite happy to hold that bond or loan for the next 20 years out to maturity. But over time, things are going to change. There might be risks with that position that have emerged over time that you're not comfortable with. It may just be that it's performed so well that the credit spread has come in a lot, and actually you're not being paid significantly. You're not being paid very well to hold it anymore. So you could carry on holding it. But actually, if there's something better that you could invest in, it might be lower risk, it could be a slightly better return. Why would you not? Why, all else equal, would you not do that? Now, that new bond or loan that you're buying, you're then thinking, I can be comfortable holding that to maturity. So what it's really not is like a short-term trading mentality. You're not buying a bond or a loan and then thinking, I think the price of this is going to improve significantly by the end of the year and I'll do that and then I'll sell it out. It's really not that mentality at all. And I think of it as actually quite consistent with what we do on the new business side. Anytime you're trying to find the assets with the best risk-adjusted return, subject to all the kind of constraints that you've got. And if you're doing that for new business, why would you not be doing that for your current portfolio as well? But it still do think of it as a long-term buy and hold approach, but just an optimized version of that.
Thanks, Rob. And a follow-on question. You talk about a lot of the in-house expertise and getting access to new asset classes. Can you talk me through your decision-making process for whether you access asset classes in-house or externally?
Yeah, it's always one of the things I've actually really enjoyed working at PIC, and that we've always approached this problem or sort of opportunity and to just how can we do this in the best possible way. And so if we find an asset class that we want to access, there's no sort of starting point that says we must externalize it or we must do it in-house. And we probably now manage about 80% of the portfolio in-house, but it probably would have been about less than half if you went back kind of 10 years ago. Ultimately, you're going to look at, and I think really you want access to the best investment expertise for what you're trying to achieve. And in many cases, there'll just be areas where we might be subscale, where that would be an obvious one when you're looking to externalize it. Or it might just be they've got access to just a better pipeline of assets than you do through their kind of experience of being in the asset class for a long time. So they'd be obvious reasons that we might look to externalize it. But I always say when you're in this kind of business, if you're a widget maker, you can't outsource all making of all your widgets like that. Because back to this point around, I think we spoke about this earlier, that the sort of beating heart of PIC is actually an insurance investment business. And if you look at things like the sort of either managing kind of public credit portfolios, so your area Hartej, or you look at the kind of or much of the private credit portfolios, it would just be inefficient to do those things externally. I talked about the portfolio optimization process or the new business process. Doing that with an external manager is possible, but just hard, because you will end up wanting to speak to the portfolio manager, to the sector analysts on a daily basis. So this is not a portfolio that you can give to an external manager and say, look, we'll see you 3 months to talk about how performance has done. This will be, even if it is externally managed, it will be an intensive partnership relationship. And then if you look at, if I look at the kind of on the private credit side, and actually decision to build that team was prior to me joining PIC in 2015, but one that I'm hugely supportive of, is that we wanted to be able to source lots of different types of private credit. We didn't want to go out and give a manager an infrastructure mandate, for example, and another one a mandate in kind of social housing, because that's just quite inefficient. And back to this optionality approach, you don't know where the best risk-adjusted returns are going to be over time. So we built a private credit team in-house with a wide range of capabilities and skills so they can pivot between those different opportunities. And those sort of things, they just don't really exist, particularly with kind of external mandates. And then you go back to the sort of, we've got this quite intensive relationship between asset liability management and the asset sources. So they'll be having these detailed conversations around, could you, if it's in private credit, could you slightly change the terms of the deal? Could you extend the duration? Are there things that you could change the cash flow profile to so we can improve? It might be improving our pricing so we can offer a better deal to the scheme. Those things are just quite hard to do with an external manager. But again, there'll be times where it's just better you can take advantage of it. It's cheaper and better and easier to use an external manager. So I don't think there's almost a set of rules you could go through. And so it's very much case by case. We'll do whatever the best thing to do is.
So, Rob, you've been at PIC now, I think, 10 years? Yep. So over that time, how do you think the investment style of the organisation has changed? How have you been involved in developing and changing that investment style?
Yeah, I mean, I think the overall philosophy, I don't think has changed too much. So we talked about those things about like not believing in strategic asset allocation, believing in kind of optionality. I think those things are at the kind of heart of what PIC has done over the last 10 years. What I think has happened is we have sourced a lot of the asset management because we got to the point where our capabilities had grown and perhaps what we wanted to do with the portfolios had changed slightly. So those things have changed. We're investing in kind of significant number of additional asset classes that we weren't investing in back in 2015. I think our hedging strategy is probably significantly more advanced than it was. And then, we've also done things like once we built out a private kind of credit team, we also looked at saying there's a section of our assets where we don't have to invest in fixed income. So the assets that backing our capital requirements, surplus, etc. And we've all tried to diversify those assets away from kind of credit. And we built a function where we could look to source whole assets, so both the equity and the debt. So things like the build to rent sector is a good example of this that we've done. So we can find assets which are great for backing long-term pensions, long-term defined benefit pensions, but perhaps in their raw form don't meet things like our regulatory requirements. But we found ways to structure those and split them up between equity and debt such that we could make them work for the different kind of parts of our balance sheet. And then I guess probably the last part is we're now in a really interesting environment where many markets are pretty expensive, actually. So, this has been the last few years, probably been the first time in my career, actually, we've been de-risking a significant amount of the portfolio from a kind of macro perspective, just where we look at it and say, we just don't think we're being paid well enough to take on those risks systematically. We've been de-risking the portfolio over the last few years.
So how do you measure the de-risking of the portfolio? Because obviously you're looking at it from a risk management perspective. How do you define whether or not what you've done or what you're doing has been right?
Yeah, that's a good question, actually, because ultimately it's measuring performance in a bulk annuity business. We have a sort of financial metrics. Ultimately, they're the sort of the arbiter of, are we doing well? So it might be, they now move into insurance terms. Are you generating enough embedded value, enough kind of own funds? Are you generating enough IFRS profit? So those are ultimately the kind of things you do. But investing in an insurance world is a bit funny. And I'll explain what I mean by that. So, for example, the market value of our portfolio, it's a bit odd, but it doesn't matter that much. Because for the majority of our portfolio, we're matching the assets and the liabilities. But you think if I've got a bond and think of it as matching sort of a member's kind of pension scheme, as long as it's there and it's paying those pensions, whether the value of that bond goes up or down or not doesn't really matter. So we're quite different from a typical investor, or even compared to a normal pension scheme where they look at the overall sort of value of the assets and the liabilities, and they'd be a bit less well matched than we are. So I ended up in this sort of quite curious position particularly when credit spreads are tight like they are now, I want the value of our portfolio to fall, because that would mean there'd be better investment opportunities to deploy capital and earn some better just risk-adjusted returns or offer better pricing to kind of pension schemes. So I guess, to your question, how do we know if we're doing the right thing? Are these sort of de-risking things the right thing to do? I would look at it and say, when credit spreads are in the sort of single-digit percentile level, so you're into is this the fifth, the one, are we really in that sort of tail of the kind of percentiles where things are just incredibly expensive? They could stay more expensive for longer. I'm a kind of a big believer in, you can't tell when investment markets are going to change, but they don't stay expensive forever. So ultimately, you only really know whether these are the right decisions in the kind of long term. But I look at it and feel they're fairly safe bets, because if you're just not being paid very much for the risk, objectively, that feels like a good time to de-risk for me.
So if I could just make a follow on. So at the individual asset level, we know that sort of, I guess, markets are expensive versus history, and the sort of external environment seems very uncertain. How do you make decades long investments in this environment?
I suppose that's the challenge and that's the fun of the job ultimately. And I think the way I look at it is most of what we're doing is investing in various different flavors of investment grade credit across the kind of corporate or kind of public sectors. And if you look back many decades, like investment grade credit is incredibly resilient to all of the different kind of shocks that the economy might face. And so the way I look at it is to say we're never really going to know what the future's going to bring. And we know that on an idiosyncratic level, there'll be problems with credits. Even the very best credits, there'll be unforeseen things that can happen occasionally. But if you're appropriately stress testing your portfolio enough, you can build a really robust portfolio that's going to perform ultimately in pretty much any kind of market environment. I think if you're out there trying to predict what's going to happen to the yield curve, what is a particular sector going to do really well or not, and taking a big bet on that just feels like a bad approach. Whereas like having a sensible long-term strategy where you're highly diversified, but you find some really interesting, safe sectors to invest in, that's going to ultimately, I think, do well for us. And I guess I'd look at it now and I think it's almost like back to the de-risking point we just made. We could be wrong, or we could have sold some of our bonds too early. There could have been a bit more money on the table there. But actually, I think I'd look at it and say you want to be going a little bit too early is a lot better than being too late and missing the opportunity.
Are there any examples of really hard decisions that you've had to make from an investment perspective that were either challenging because it was uncertain or challenging because the outcome didn't meet what your expectations were going into it?
Yeah, look, I'm sure there's lots of those. I guess something that comes to mind, I think back to the 2022 LDI crisis as a sort of really interesting time. And the thing for me that's really interesting about that is that it showed how robust the kind of portfolio was. So that was, if you think about it, really how that sort of manifested itself for pension schemes and insurance companies was not like the actual underlying assets were doing badly as such, but we had the value of gilts was falling, so yields were increasing very rapidly. And then for most pension schemes and insurance companies, that meant posting more collateral out. And that was something that we were very well prepared for, own significant amounts of kind of additional collateral over and above what you think could be the kind of worst case scenario. I think what's really interesting when you're in that scenario is when you're in the middle of the crisis is how you react to that. And we took the decision to raise additional kind of collateral because you always want to be in a position where you're not actually using your buffer. And I think that's a really interesting sort of challenge when you think about it is particularly for kind of insurers, you've built up a kind of a buffer and then the crisis comes and then everyone automatically says, I want to have the same buffer again. But by definition, you're in the crisis. So I don't think there's a magic answer to that. But I think that's sort of a really interesting one that I'd probably still reflect on now is with hindsight, it's really easy to say with what you've done. But when you're in the middle of a crisis, it's a slightly different challenge.
What's the likelihood of something like that happening again? Has the market learned from what happened in 2022?
So I think the market has changed. I think it's changed significantly on the pension side. And I think it's probably also changed politically. So I don't think you're that likely again to have a kind of budget where you haven't had the Office of Budget Responsibility has run the sort of has done an assessment on that. Secondly, I think the sort of the biggest challenge is you had a bit of this snowball effect where gilt yields were going up. That was causing stress on the mark to market of kind of pension scheme and insurance companies' derivative positions. Now, the insurance industry generally did really well through that sector because they've got such a cautious mindset. They held significant amounts of additional kind of liquidity and they've got professional in-house teams to manage it. And for the pension scheme side, that wasn't to the same degree. So I think, what you've seen from the kind of pension scheme market has reacted to that by changing the nature of their derivative agreements, so widening out the types of kind of collateral they can pay and increasing the amounts of kind of collateral that they can hold. So I think it's significantly less likely you'd see a challenge like that in the future.
Let's move on to UK investing. Obviously, PIC are quite prominent in investing in what you could term as UK PLC. So what's behind that? And also, what's your thinking about how you might go about continuing to invest in the UK and the opportunities available to you and your portfolio?
Yeah, look, we're a UK company, and we are almost exclusively paying sterling pensions, sort of small kind of exceptions. So yeah, it would be no surprise that we're a big investor in the UK economy with that. A big supporter of the UK. I think we're talking ourselves down in our kind of future prospects. I think we're doing a great job of talking ourselves down right now. So that will always be a kind of core part of what we do. Is there's some great opportunities within the UK to invest. Actually, we'd like to do more. If we look at things like infrastructure investing, that's a absolutely perfect being a debt investor to infrastructure, UK infrastructure projects. So sort of imagine the long-term, stable cash flows, often with some sort of implicit or explicit sort of government kind of support, and at the same time enables us to invest in the UK economy for the benefit of future generations. What's not to love if they're the right projects. What we really see those, just there aren't enough of those projects for us to invest in. And I think that's a bit of a misconception that repeated many times. I think there could be this perception, which is if we could just get those pesky institutional investors to invest more in infrastructure, then more infrastructure investing will come. And my comeback is, please show me the opportunities that the institutional market hasn't invested in that haven't happened. I think actually the challenges are much bigger around things like planning, as an example, and how difficult it is to get these sort of projects off the ground in the first place.
So, as a CIO of a UK company, if there were more opportunities for you to invest in UK infrastructure, you would take that.
Yeah, absolutely. Yeah, of course. I think actually the government's doing really good work, and the sector has heard the messages, I think, from the investment sector loud and clear. This is hard yards to get through this stuff. Yeah, I think it'll be a core part of it's been a core part of our strategy in the past. We'd like it to be an even bigger part in the future. Look, at the same time, we're always going to diversify. We're not going to make just a sole bet on the UK economy. You would expect us, quite rightly, to be diversifying our kind of strategy. I think within our corporate bond portfolio, I think we were a sort of a market leader in looking at being quite agnostic to where we invested, as long as we could find the best investment opportunities. And that's grown into our private markets portfolio as well, and will continue into the future. But we are a UK company with UK policyholders, and investing in the UK is always going to be a key part of what we do.
And I guess just as a final question on the UK, do you think the recent regulatory changes and things like the National Wealth Fund, are they helping provide opportunities? Are they having their intended outcomes?
Yes, I think we're at the early stages, and I think there's like an absolutely sort of crucial role for the National Wealth Fund to be an enabler of investment. So things like providing early stage investment in projects, I think, is really key. The ability to provide things like guarantees so that they can crowd in the kind of sector, I think, is really important. I still think there is a fundamental challenge which probably has not quite been reconciled, is that the kind of private sector capital will almost certainly always going to be more expensive than borrowing via gilts. But the fiscal position of the UK economy means that funding via gilts is going to be a kind of a challenge going forward. So we need to crowd in kind of private sector investment. But that's difference between the two. The cost of the public and the private sector capital has probably not been quite resolved, I think, in that debate yet, but it needs to be in the coming years.
So, Rob, I said at the beginning, I'm the one that asks sometimes the hard questions. So here's one for you. What's been the most difficult investment decision that you have made, and what did you learn from it?
Yeah, look, I think it was actually quite a small investment. But if I go back to my time at PIC, I remember actually an investment we had in a fund with a kind of an external manager. And I remember when I came on board at PIC, everyone loved this investment, and we'd been a sort of an anchor investor at the kind of start. And I remember meeting the team there and just being really not particularly impressed, not liking the kind of investment strategy that much. It wasn't a big investment. It was still fairly meaningful. But actually the internal kind of noise around the investment was really positive. And actually, subsequently, we had some quite poor performance from that kind of fund. And I always look back at that and feel like, you know what, you should have backed your intuition and got out of that investment earlier than you did. And I think it's really, so I guess what's the lesson? The lesson is always, sometimes just don't believe the hype. Trust your own judgment, trust the sort of judgment of your team. And if you see the things that you are concerned about, just keep pushing, keep digging, and don't let the sort of the noise around it put you off what you're doing.
Yeah, it sounds, obviously, you've been speaking about the culture within PIC earlier on in the session, but it sounds like you have a great culture at PIC. How do you go about allowing the likes of Hartej, come up with ideas for you to be able to vet and challenge, or even to incorporate some of those ideas into the investment strategy?
I don't know, maybe Harkadej can answer that better than I can. But no, look, I think it is really about that kind of culture point, isn't it? I think you want hopefully I would be as a CIO, but also kind of across the management of PIC, but then and across the leadership team within investments. You're trying to encourage that culture of kind of innovation. So, where new ideas are always welcome, but where the team is able to like objectively challenge those ideas, you're going to work together to try and get good outcomes. And we're always trying to ask ourselves the question of how can we do better as a team? And if everyone buys into those principles like that, and that they know that their ideas are there to be coming up with new ideas is encouraged. It doesn't mean it's necessarily going to get in the portfolio, but it will be looked at in a kind of really serious way, in a really objective way. I think that's the key.
And just to follow, so you talked about some of the building blocks of culture. When you're looking at hires, and either at the entry level or indeed at the more senior level, what might you over-index versus some of the other people out there? So what do you find important that other people might find less important?
Yeah, that's a good question. Yeah, because there's lots of things, isn't there, that we'd all our sort of employees to have. Everyone wants clever people. Everyone wants hardworking people. Everyone wants people that are going to get on with other people. They're going to be nice to work with. I think the thing I would probably over-index would be the sort of, and I think this is could be at any level, but I think particularly level is people who are going to like solve problems, are going to work out how to solve problems on their own kind of initiative. They might see a problem. It might not be exactly in their kind of core area, but they're going to push on it and help and find a kind of solution to it. Those real sort of self-starters. And I think a lot of that comes through being curious as well. So it's something around sort of internal motivation, curiosity, and self-drive. And I think having people in your team that tell you about a problem, but also tell you how they're going to solve it, they're just absolutely worth their weight in gold. Yeah, I think I'd over-index that.
So true. We're coming towards the end of the podcast, but there's a few questions still to ask. One that I was intrigued about to know, how is AI, or more broadly technology, impacting the investment process at PIC? How are you using it to make some of the decisions that you might be making?
Yeah, look, I find AI fascinating. Like, I think you have to recognize, I still think we're really at the early stages of AI. We don't quite know, do we, any of us, how much impact it's really going to have on us. I think there's a quite wide uncertainty there. But I think if you look at, actually, I could say this for PIC, but I think if you look at the financial services industry as a whole, that there's huge amounts of the work, which is essentially take some raw data in one form, do some calculations or transform that data in various ways and then interpret it. And then, you think of the huge numbers of people who are involved in that. This feels like an area that AI should be hugely beneficial to us over the kind of years. And so I think we're at the start of that journey. I mean, like an obvious area that's been really useful for ourselves so far has actually been within credit research. So these are the teams that are responsible for, you have like sector credit analysts, they're responsible for the names in the portfolio, the other names we don't hold in the sector, keeping on top of the names, doing kind of credit ratings, doing credit reviews of particular names. And if you're doing a credit review of a name, you're looking to try and find out what's going on in that kind of sector. You're looking to dig into the kind of financial results. You might be looking at any kind of public statements that come out. You might be building up a rating scorecard. We found that has been hugely beneficial. So we've got some specialist AI tools within that sector. And so that's making the sort of jobs of the analysts easier. So you both improve the quality of the work they do, but also mean that we're more scalable. I think in kind of technology generally, it's again, back to this point of taking in huge amounts of data, transforming it in some ways, and then using our judgment to work out how we take investment decisions on things like portfolio optimization or sort of more generally asset liability management. We're making kind of huge advantages there and just enables us to take better investment decisions. But I really think we're at the start of that journey, particularly on AI. I think it's a long way to go.
And more broadly, for people who are looking to go into the investment field, what advice would you give them today? First of all, would you tell them to go for it? Might you dissuade them?
I find investing absolutely fascinating. That combination of seeing all the events that are going on out there in the world, taking all those into account, and then trying to pick investments that are going to perform long term to the future. I find that's kind of a fascinating challenge. And I think it's just so many different areas of investing. If you think about investing in an insurance company, investing in a pension fund, investing in a sovereign wealth fund, investing in a hedge fund, there are such hugely different kind of jobs. So I think there's just, I would definitely see it as an attractive place for kind of young people to go and a wide variety of career options open to them.
So we've come to the end. One last question before we do the fun round. What would you want your legacy as a CIO to look like, to be?
I would hope it would be someone who built great teams. I think if you do one thing as a CIO, to me, it's around building a really strong team that can ultimately deliver performance. But if you get that team and that culture working well, I think that stands you in good stead for whatever investment markets bring at you.
Okay, so we've come to the end, but we always finish with the favourites section. So quick fire round. Rob, this is for you. Favourite sport?
Snooker.
Oh, did you watch last night's final?
I did. I didn't actually watch the end because I went to bed. But
I did. Favourite film or TV drama?
Oh, I'll go with Breaking Bad.
Never watched it.
Oh, you're missing one there. So we're watching it for the third time, which is the only thing I've ever watched
My
more than. But yeah, the best thing I've ever seen on TV.
A favourite drink?
Favorite drink? I'll go for an oat flat white. I'm a big coffee fan.
Very good. Favourite book?
Favorite book? I will probably go. So I love a kind of a good novel, and particularly remember when I was at university, Train Spotting by Irvin Welsh came out as a book, and I just remember it being like hugely original, but also just hugely powerful. So yeah, I'll go for Train Spotting, the book, not the film.
And last, favourite hobby?
Favorite hobby? I love exercises. I love going for a run. Yeah, if I have a day where I'm lucky enough to work at home, I'll try and do a 10K before
Fantastic.
work. So
Ever done a marathon?
no, I've done a half marathon. It's on the to-do list.
To-do
at
list,
some point.
the bucket list.
Yeah.
Excellent. Listen, Rob, it's been an absolute pleasure. Thank you so much for joining us today on the CIO Chair. We look forward to perhaps interviewing you again sometime soon.
Thanks, Sean.